Hi, everyone. I'm John Kosar, Chief Market Strategist at Asbury Research and Asbury Investment Management. Welcome to your Daily 5 for Friday, June the 12th. Here are my top 5 charts for this week in just 10 minutes. The first chart is what we like to call the game board. It shows the S&P 500 and the key levels above and below the market. So here we have the S&P going back about a year, and what we're showing here, probably the most important thing is you see the rejection that we've had this week from trying to get through overhead resistance here at 32.15. This is the spot S&P 500. It's the January 31st benchmark low here. We got above it for a day and a half, and then we fell out of bed yesterday. As everybody knows, we had an awful day yesterday. Interesting where the market stopped. It stopped right at the 200-day moving average, a hair below it, but effectively right on it at 30.13. And this morning, the S&P 500 is up about 60 points. So we're testing the 200-day moving average after getting back above it a couple of weeks back. It's a major inflection point. And right underneath there, you've got the April 29th high I'm pointing to here in green at 29.55. And coming up from below is the 50-day moving average, which is a minor trend proxy. That's coming in at 28.92. So you have this cluster of important areas here as the 50-day gets a little closer to the cluster. So that's what we're paying attention to. If this move higher through the 200-day moving average was indeed the resumption of the secular uptrend that started back in 2009, we should hold this as support now, the 200-day. Market internals is a big thing in our shop. 10 years ago, certainly going back further than that, you could almost watch the S&P 500 every day and get a pretty good indication of what the market was thinking. I don't think that's so much the case anymore. I think a lot of that has to do with more computerized trading, a lot more algorithmic trading. A lot of these algos are seemingly meant to kind of fake investors into buying the highs and then fake them into selling the lows. So we look at a lot of internals, and we actually name them the Asbury 6. It's a lie detector for us. This is the lie detector for the market. We have 6 key indicators here, only one of which is the S&P 500's monthly rate of change here up top. Only one is purely price dependent. The other 5 are non-price indicators like relative performance of stocks versus high yield bonds, volume, market breadth. This metric turned positive for us. 4 of 6 are positive, by the way. This metric turned positive on April the 9th, but just as of yesterday, we have lost 2 of those to the red column or the negative column. And that's relative performance of stocks versus high yield bonds and investor asset flows in the spider. If we go to 4 red, this would indicate a negative signal. And the last negative signal that we had in this particular metric was on February the 24th. So now I want to look at one of these specifically because a picture tells 1,000 words. Asset flows, which we call trend fuel. You need flows to make the price of an asset go up, whether it's stock or futures market or whatever it may be, real estate investment. You have to have flows in there to make it rise. And if you don't have those flows, the price typically falls. So here's one of the Asbury 6. We have the S&P 500 here up on top, and underneath here, we have the total net assets invested in the spider since the beginning of 2020. Since back in January. And what it shows here, it has its 21-day moving average, I should mention. Why 21-day moving average? Because that's Asbury Research's tactical time period. It's one business month. So you could see from October 14th of last year to February 21st, we were, for all practical purposes, up above the 21-day moving average. Failed on February the 24th, which incidentally is when our Asbury 6 turned to negative. Stayed there till April 3rd. On April 6th, it moved back above the 21-day moving average and caught this nice rally in here. Now we've edged below it. You can't really see it on this chart. You don't see the the detail because it goes back to the beginning of the year. But these assets actually edged slightly below the 21-day moving average as of the close yesterday, June the 11th. We're watching this like a hawk now, especially since the S&P 500 is testing the 200-day moving average. This screams inflection point to us. If the market's still good, it should hold in here, and we should see these assets spike up over the next few days, showing that there's some new money, some new buying power coming in. In the absence of that, we're going lower. Volatility, which is one of a handful of indicators that we call trend triggers. We like to watch them on a tactical basis to give us an idea when we might be seeing a trend change. So here we have the VIX up top here, going back to looks like middle of March. On March 31st, it dropped below its 21-day moving average. The VIX did. That was a pretty good signal for an opportunity to buy the S&P 500. And you can see the VIX has really kind of ridden the 21-day all the way down. And if you look at these few dates that I've had highlighted where the VIX actually came up and kissed the 21-day and failed, April 21st, May 4th, May 14th, were all little minor bottoms in the S&P 500. Look what happened yesterday. The VIX spiked pretty convincingly up above the 21-day moving average, and it's up above there now today. If this is the start of a new trend, then history tells us that we are likely to see a follow through on the downside from what we saw yesterday, a move through the 200-day moving average, and possibly a lot more pain for the longs that have jumped in this market over just the past couple of weeks. We put a piece out yesterday to clients that showed just the big spike in investor assets flowing into the spiders just within the past couple of weeks. Kind of makes the market top heavy. We call that a Jenga market here. You know, if you've ever played the game of Jenga where you're stacking the blocks up. Sometimes when you get a rush of assets, especially if they're retail assets, if you could identify them as being more weak-handed retail traders, and you see that kind of top heaviness Jenga market, you really have to pay attention to where those levels are that this new money came in, because if it goes through there, oftentimes it sparks a big sell-off. That's exactly what we saw yesterday. Finally, investor sentiment, which in this case is whistling past the graveyard as far as I'm concerned. What we have here on chart 5 showing that retail traders are too bullish. We have the S&P 500 here daily from 2018 up top, and this underneath is a daily survey of futures trader sentiment going back that same period. And what you can see here is when these traders get to be about 80% bullish or better, this is not a timing tool like the VIX would be a timing tool or Asbury 6 would be a timing tool. This is more of what I'd call an environmental tool. If you think of this in terms of a baseball game, once we're up here 81% bullish or better, it tells you that we're in the 8th or the 9th inning of this particular baseball game that started at the previous lows, and you should start keeping your ear to the track for changes in the tactical trend of the market, spikes in fear, things of that nature. So what we have here is through yesterday, you can see that we spiked up above 81% bullish. Now we're starting to come back down, and you go across the chart and you find other instances of this. And again, this doesn't tell you the day at the top. It doesn't ring a bell at the top, so to speak, but it does let you know that you're getting close to the end of this ball game. And in this case, the ball game that started at the lows on March 23rd. So this is just more of an indication that you really need to pay attention now. You're paying attention to several things here. You're watching volatility. If you're an Asbury subscriber, you're watching our Asbury 6. Or you're also watching the VIX, paying a lot of attention, because when investors are too happy or too carefree, bad things happen. So that's your daily 5 for this week from Asbury Research and Asbury Investment Management. Thanks for watching, and we will see you at the next one.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.